On Thursday, the small cap Russell 2000 index entered a bear market. On Friday, the Nasdaq 100 index entered a bear market, so it looks very likely that the S&P 500 may enter a bear market this coming week. Now, the last 4 bear markets I went through made me even richer. So here's how I'm taking advantage of this coming bear market. Now, first of all, let me define what a bear market is. A bear market is when the price drops and closes 20% below the previous peak. So like I said, that the Russell 2000 closed 20% below the peak, Nasdaq 100 closed 20% below the peak on Friday. Now, the S&P 500, which is the main index, has not yet done so. It is down roughly about 17% from the peak. But given that the first 2 indexes have already entered the bear market, there is a high chance, again, it's not a guarantee, but there's a high chance the S&P may enter into a bear market this coming week if the price keeps dropping. And so the S&P has to close below about 4873, somewhere here, so close below there, for it to be a bear market. Now, you've heard me say in the previous videos that I thought a bear market was very unlikely. Well, it looks like the unlikely could be happening. And that shows you that it's, anything can happen in the markets. Anything can happen in the markets because there are so many moving parts in the economy, in politics, that there's no way to predict for sure. So in the first place, why do I say that it's very unlikely for another bear market to happen? Well, because we just went through 2 bear markets in the last 5 years. Now, let me tell you how rare it would be to get another bear market right now, but to also explain to you how it could happen, even though it is so rare, okay? So if you take a look at the last 74 years, since 1950, there have been altogether 12 bear markets. So if you take 74 divided by 12, that is a bear market occurring on average once every 6 years. Now that makes sense because most bear markets occur as a result of a recession because of the economic boom and bust cycle that takes several years to play out. If you take a look at the last 2 bear markets, they happen very close together. So for example, we had the 2020 bear market where the market dropped 35% to the bottom. And then in 2022, we had the bear market where it dropped 27% to the bottom. Now, why did it occur so close? And why is this one potentially occurring very, very close? The reason is because the last 2 bear markets and this one is not caused by the normal economic boom and bust cycle. These bear markets are artificially induced by the government. So for example, in 2020, what happened? As a result of the pandemic, the governments in the world decided to do a global lockdown. So they shut down borders. The moment you shut it down, it shocked the system. And that's why we had a bear market. And we had a very fast drop and a very fast recovery once they opened up the borders and there was a vaccine. Same thing in 2022. 2022 was also artificially induced. Because of very high inflation, the Fed had to kill inflation, so they raised interest rates at the highest rate in 40 years. Now, bear in mind that there was actually no recession that occurred, but the market kind of like priced in the recession. So when there was no actual recession in 2023, where everyone predicted it, the market rebounded back to all-time highs, as you can see over here. Now, and the same thing is happening right now. Right now, there's nothing wrong with the economic cycle. The economic cycle is going on very smoothly, but again, it's being artificially induced by the Trump administration, where they are slapping these super high tariffs and shocking the system. And that's why it could potentially create another bear market in the S&P 500. So is this good news or bad news? Well, I'm a kind of optimistic person. I like to see the cup half full rather than half empty. And the way I see it is why I think it's good news is because, again, these bear markets are artificially created. And so because they're artificially created, once the Fed or the government, they decide to shift their policy, the market would reprice very quickly and we are back to all-time highs again. Of course, the million-dollar question is that will the Trump administration shift their policy, shift their narrative, or will trading partners blink first and decide to lower tariffs so that the US will lower tariffs? That is something that there's no way to predict. Unless you're sleeping with Trump, by his side, you can hear him talking in his sleep, or you bug all the officers of all the foreign countries in the world, there's no way you can predict this. There's no way to know when that shift occurs, whether it's even going to be this year or next week or next month. No one can predict. But the moment that shift occurs, markets will reprice all the way back to all-time highs. So remember that the reason the market is going down right now is that it's not because of a deterioration of the fundamentals of the business. The fundamentals are exactly the same. The market is basically going down, anticipating that there will be a global trade war and recession that has not yet occurred. So remember that the market is not the economy. The market doesn't reflect what is happening to the economy right now. The market prices in reflects what could happen to the economy in 6 to 9 months. So, as long as policy changes and narratives change before there's real economic damage, before there's real deterioration of fundamentals, then of course markets could go up as fast as they came down. Now, while I can't predict exactly when that's going to happen, let me give you a bit of a silver lining. This current market drop has been very rapid. You can see the market has dropped in a 90-degree fashion. Boom! And we call that a parabolic drop. My friend Adam Khoo likes to call it a flush down. Now, I love it when markets drop 90 degrees. Why? Because from experience, I found that the faster the market drops, the faster it rebounds back up. It's kind of like a rubber ball. The faster you throw the ball down, the harder you throw the ball, the higher it bounces. But if the ball goes down slowly, then it takes a long time to get back up. Let's take a look at a few examples in history. So in 2020, if you recall, market dropped rapidly as well. You can see that very sharp, almost 90-degree drop. And the market basically took 22 days to enter a bear market. Think about it, in 22 days, it dropped into a bear market. The market dropped and closed 20% from the highs. And because it fell so fast, you can see the market recovered very fast. And by the end of the year, the market was up 18%, right? Now, look at the difference in the dot-com bust and the great financial crisis. Now, the dot-com bust that happened in 2000, 2001, the market didn't drop rapidly into a bear market. It took a long time. So it was just like a slow, agonizing, painful death by 1,000 cuts, right? So in fact, you can see from the high over here, there was a high of the market. It went okay. It took 353 days to enter into a bear market. Think about it. It took almost 1 year to get into a bear market. And that's why it took more than 2 years to recover back to the highs. What happened in the great financial crisis of 2008, 2009? Same thing. The market went down very slowly. It was an agonizing, painful death by 1,000 cuts. From the high of the market, went down, right? Now, over here, you can see this red box represents a 20% close from the high. You can see that in the global financial crisis, it took 265 days to enter a bear market. Again, it took a very long time, and hence it took over a year and a half to recover back. So once again, sharp 90-degree drop, high chance of a fast rebound to all-time highs. Slow 45-degree decline takes years to recover to all-time highs. And this current tariff war 2.0 that we are now going through is a very sharp parabolic drop. And again, the S&P 500 is not yet in the bear market, but next week, if it drops into a bear market by hitting 4873, then we would officially enter into a bear market in less than 50 days, which is considered a very sharp drop. Now again, let me show you examples of past sharp drops, past parabolic drops, and what happened thereafter and how fast was the recovery. So let's take a look at the last 4 examples. So once again, the most recent example was the 2020 COVID crash. And you can see again from the all-time highs, the market dropped parabolic, almost 90 degrees, and it was 35% all the way to the bottom. And from the bottom, by the end of the year, it went up 70% from the bottom and closed the year up 18% year to date. sharp drop, sharp recovery. Then the crash just before this was the 2018 trade war 1.0 and 2019 taper tantrum, when the Fed decided to stop quantitative easing and to raise interest rates. So let's see what happened there. So same thing, you can see there was a high of the market, and the market again dropped very rapidly. There's a parabolic drop right here. Market dropped 20%. Now this was not officially a bear market, but it did drop 20%, and it was very rapid. By the end of the next year, you can see it was up 38.7% from the lows, and it closed 2019 up 31%. Now, this particular year where the crash started, it started in October in the last 3 months, but despite that, 2018 ended down 4.23%. Down, but still not that big, only down 4%. Let's take a look at the one previous to this, which was the 2015 to 2016 China shock, where Chinese growth slowed down and oil prices crashed. Now, this was not a bear market, but this was a very sharp parabolic drop as well. You can see here 90-degree drop, boom, and another sharp drop, boom, and you can see from the bottom it went up 24.8%. By the end of 2016, the market was up 11%, and by the end of 2015, where this first drop occurred, market ended positive as well. Last example of the parabolic drop was 2011. Now, this was caused by the US credit rating being downgraded from AAA to AA, plus the European sovereign debt crisis. We had two crises going on at the same time. And you can see what happened in 2011. The market again dropped rapidly over there. So it dropped 21.6%. But by the end of the following year, which was 12 months later, you can see the market was up 34.37% from the lows, and it ended 2012 year-to-date gain 15.89%. And even this previous year, when the crash started, the market ended up 2.1%. So am I saying that this current crash we're in has bottomed? I'm not saying that. Of course I'm not saying that. It could still go lower. But the question is, would I be a seller right now? Would I want to sell my stocks right now, or would I want to short the market right now? Hell no, I wouldn't want to do that, even though it may not be the bottom. I tell you why. Because again, if you take a look at history, every time there is a very sharp drop like that, okay, even if it's not the bottom, it would usually have a sharp rally before going lower. Same thing, take a look at the previous example over here. When you have a sharp drop, even though it may not be the bottom, right, there was a bigger bottom coming, but you can see a sharp rally, and then drop back down. So one of the common mistakes that people make is that when they see the market dropping rapidly, they panic, or they get a margin call, whatever it is, right? And at this stage, they may sell in panic, or they short the market. And once they short the market, what happens? The market goes up, they go, oh shit, right? And their shorts get killed. Or they say, shit, I sold and now it's a higher price. And so they think, okay, the market's recovering, and they buy back here. And what happens after they buy back? It goes out again, pop, shit! It gets stopped out again for some people who've got a stop loss. And then they say, okay, let's short the market again. So they short the market again, or they sell everything, and then it goes up, and their shorts get killed again. Okay, and they say, okay, let me buy it all back, and it goes down again, they go, They get screwed both ways. And finally, when they throw in the towel, they give up. What happens? The market, hallelujah, it goes all the way up again. So coming back to the present day, let's take a look at the S&P 500. It has so far sliced through the first two support levels that are identified, and it's now close below the second support level. Now, the third support level over here, this is about a 20% drop. So next week, if we get further retaliation from the Canadians, from the Mexicans, from the Europeans, and they join China in retaliating and raising tariffs, creating more uncertainty and more panic, then sure, we could close below that 4877 and be officially in a bear market. So again, in a bear market, how low can we go? You can't predict exactly, but historically, bear markets tend to bottom between anywhere from 20% from the highs to 35%. I personally do not see that this correction or bear market goes more than 25% below the high. So to me, I think the last level of support that we'll see in the S&P 500 before it finally bottoms would be somewhere around 4,657 thereabouts. And how did I get this support level? Well, if you take a look at the monthly candles right here, you can see historically the S&P 500 has had a very strong support at the 50 moving average. It dropped, it bounced, right? It dropped and then bounced from here, although it did have a bit of an intra-month low. It dropped, it bounced off the 50 right there. And again, right now it's dropping. I see this 50 moving average on monthly candles as the last support before you get that eventual bounce. But again, like I said, if it does get to 4,657, it will not be in one straight line all the way down. In fact, I expect that very soon, in the next few days, maybe Monday, Tuesday, Wednesday, we should get a pretty sharp rally back up, a relief rally. There's usually after a sharp drop, you have a relief rally. And indicators are showing that the market is very oversold, poised for rebound. Let's take a look at some of these indicators. So one of the indicators that I like to look at that was created by Larry Williams, the legendary Larry Williams, which I've got tremendous respect for, is this oversold indicator. This works on the weekly candles on the S&P 500, and we're looking at three main indicators. Primarily the first two, which is the Williams percentage R 52 period close, the Williams percentage R 13 period close, and you can also look at the ATR normalized, which is kind of like a bonus, but it's not 100% necessary. So it's looking at the first two indicators. And what we are looking for a very high probability of a bottom. Again, it may not be the absolute bottom. It could be a bottom, rally, and another bottom. All right, so it may not be the bottom, but it's one of the potential bottoms. So you tend to get a potential bottom when you see the Williams 52 go below minus 80 and the Williams 13 also going below minus 80. So when these two lines, this blue line and this orange line, they go below this level here, right? So like this here, this is a very clear signal of an oversold market ready to bounce. So if you take a look at, for example, recent examples, when were they both oversold? Over here, you can see oversold, so that marked the bottom, okay? And then it bounced up, as you can see. Now here, same thing, you can see oversold, marked the bottom, bounced up. Like I said, it may not be the ultimate bottom, but it tells you that it's going to rally and it may make a new bottom and then it rallies again. Now, where else do we have it? Over here, okay? See? Oversold, that marked the bottom of the 2020 crash, went up. So right now, same thing. You can see on the Williams 52, we are oversold. So we are at a point very close to a sharp rally. Again, it may be the bottom or it may be an intermediate bottom before we get another bottom over here. Hard to predict. Really depends on how the macroeconomics or the politics play out, which I can't predict. I can just look at charts and tell you whether they are oversold or not. Now, the other set of charts that I look at, again, created by Larry Williams, would be on stockcharts.com over here. So this is looking at two additional indicators. One of them is the money flow index. This tells you when big institutions are buying stock. So when you see that this red line, which is the money flow index, goes above this green line, which is about 75, that means institutions, the big boys, are accumulating stock. And that is usually a bullish signal. And you can see what happened over here when it went above the green line, when the money flow index was in huge accumulation, in big institutions buying stock. That marked the bottom of the market over there. And right now, where are we? Right now, you can see the money flow index again has just crossed above the green line in heavy accumulation by big institutions. The other thing that I look at is the sentiment index. So the sentiment index is a contrarian index. So in other words, when the majority of the media are all very bearish, they say that it's going to be a recession, depression, we're going to die, it's a crash, that's when this green line drops below the red line, when it's extreme pessimism. And that is a contrarian indicator, because when everyone is pessimistic, the market tends to go the other way. So right now, you can see it is right there below the red line. It is at extreme pessimism right there. Now look at previous times when it happened. Over here, extreme pessimism over here. You can see it had a bounce, right? Extreme pessimism over here. We had a bounce. Here, pessimism, bounced. Pessimism, bounced. Pessimism, bounced a bit, went back down again. So again, it may not be the bottom, but it could bounce and make another bottom over there. Remember that these indicators or any technical charts, they are not crystal balls. They have got no predictive ability. They are just showing you what is the higher probability. So it's just telling you that after the price has dropped rapidly right now, it's at a point where there's a high probability of a bounce. So would I want to short the market right now? I'll be very wary. Would I want to sell my stocks in panic? Of course not. If I'm holding high quality businesses that I know will keep growing in value in the long run, I wouldn't want to sell my stock. Now, of course, if you are a trader and you're holding lousy companies that are not making money, that are highly speculative and they're overpriced, then yeah, you gotta have a stop loss and just get out, okay? But if you don't have a stop loss and you're holding to low quality companies, then I would want to get out as well. But I'll wait for a bounce to get out unless my stop loss has already been triggered. Now, for me personally, again, as an investor, as a long-term value investor, I don't sell great companies, I buy great companies. And these are the times when there's a big correction, a big bear market. This is the time where you really add great companies at huge discounts, because that is how your next million or few million is made. But again, it's all about buying high quality companies. If you look at the 11 sectors of the S&P 500, you can see where are the biggest deals on sale, right? Technology, consumer discretionary, also known as consumer cyclicals, communication services, and so on and so forth. So in my next video, I'll drill in to talk about what I think are some of the highest quality stocks in these most oversold cheap sectors that we could take advantage of while the market panics, and we can profit from that panic. So thank you for listening. May the markets be with you. I'll see you in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.